Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and happy Sunday to you. We come every week wanting to give you sincere and actionable ideas that you can use to improve the lives of yourself and your loved ones financially. You know what? Your retirement, it doesn't exist in a vacuum. Your retirement moves with the markets. It responds to inflation, and it's shaped by the decisions of the Federal Reserve. And in today's unpredictable financial climate, your financial stability, well, it actually has more to do with the Federal Reserve than you might think. The Fed isn't just some distant institution. It's the engine behind interest rates, inflation control, the broader economy, and by extension, that means the global economy. And every decision the Fed makes can ripple through your retirement finances, affect your purchasing power, investment options, your income strategy. And lately, the Fed's been front and center in the headlines again, especially after President Trump has publicly criticized Jerome Powell, the Fed chair, for how he's managing interest rate policies. Whether it's raising rates, which is what you do to tap the brakes to cool down inflation, hinting at future rate cuts, which is something you do to step on the accelerator to spur economic growth. Every move has consequences for your retirement. So how does it all connect to your financial future, from bond yields to annuity rates to the cost of borrowing? The Fed's policies affect you, and I want to talk about what that is today. I want to talk about the meaningful impact it's likely to have on you over the course of 2025 and how you should be positioning. In the meantime, 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. In fact, when you're out there, download our free publication, Trade War 2.0, so you can start getting comfortable with strategies and our voice to help you move into retirement. So when I think about this, a lot of people, everyone's heard of the Federal Reserve, but a few really understand what it does and why it matters so much to their money. You know, for some, I've had people tell me it feels a little like a mysterious force that kind of moves markets and sets interest rates behind some closed doors. But the truth is the Fed, it plays a huge role in your financial life. And that doesn't stop once you retire, because it's going to influence everything: inflation, borrowing costs, investment returns. So let's kind of break this down. The Fed has this dual mandate to maintain stable prices and maximize employment. I repeat, that's to maintain stable prices and maximize employment. So that's a fancy way of saying, let's make sure everybody who wants and needs a job has the chance to get a job. And let's make sure that people aren't drowning in double-digit runaway inflation every single year, which would break anybody's retirement. And you know what? The Fed's done a great job of maximizing employment to this point. I think the Fed would admit they would like to see some break in price pressure, some break in inflation in order to do what they oftentimes do, which is cut interest rates. But how does this really affect you in your retirement? Well, when you think about it, it's last call. And what I mean by last call is you're able today to lock in interest rates on things like bonds, things like annuities, the likes of which you haven't had for the last 5, 10, 12 years. And why is that? Because if you were buying a new house today, no one's buying a house with less than a 3% mortgage. People are paying higher mortgage rates than they've paid at any point in time since the great financial crisis. Now, for a mortgage holder, that's a negative. But for you, as someone who's moving into retirement, it's a tremendous positive, because when you can participate in asset classes like private credit that are here to generate distributions that are forward looking, potentially in the 7 to 9% range, that's a great spot. When you're a retired investor today who wants to clip coupons from fixed income, coupons from bonds, and you can build bond portfolios with yields to maturity between 5 and 6%, when you're an investor who just wants more safety, and you can go ahead and build out a portfolio of simple, straightforward, multi-year guaranteed annuities at 5% per year each year for 3 years. You know what? Those are all safer money strategies compared to investing in equities. And the reason I say that it's last call is it's not my prediction. It's the prediction from market participants. It's the prediction from the voting members of the Federal Reserve themselves as a result of everything that's gone on, all of these daily changes as it relates to interest rates and trade. We're staring at what could easily be 3 rate cuts this year. I think we are going to have at least 3 rate cuts this year. That means if someone's in a money market today paying 4%, that same money market's likely going to be paying 3.25% by the end of the year. Someone who has bonds paying 5 to 6% yields to maturity right now, new bonds bought after the rate cuts, they're going to be paying 0.75% less. So I tell people, what are you waiting for? It's time to start locking this stuff in, because if you want to get retired and stay retired, you got to follow those 3 pillars of retirement income. And pillar 1, capital matters. One of the ways for you to adhere to pillar 1, capital matters, is to have enough safety in your portfolio, safety that can come from the simple concept of a multi-year guaranteed annuity, the safety that can come from building a set of high quality bonds and holding them to maturity, 5 to 6%, diversifying your diversifiers further by adding to alternative investments like private credit that could generate returns 7 to 9% because of the illiquidity risk premium that's there. All of these are tools at your disposal, but these are things you need to be locking in now. And I know the transition for people is tough because I'm already invested here. How do I get from here to there? Well, you're going to do it gradually. We talked for 2 weeks in a row now that this market is range bound. What do I mean by a market that's range bound? Well, what I mean by a market that's range bound is we saw these lows come in back on April 8th. And by the way, April 8th, the lows were a heck of a lot lower than they are today. And then you've kind of got this upward band of 55 to 5,600 on the S&P. And somewhere in that range is where we're trading based on the headline. So what I want people to think about is, if you don't have enough fixed income in your portfolio, if you haven't locked in the higher yields that are here, then I think you need to have a plan to fade this rally, feather this rally over the days and weeks to come. And when we're trading in that upward band of 55 to 5,600 on the S&P, if you have a desire, it's a great time to sell into strength, to reposition. You're never going to catch the tippity top of the highs of the market. You never want to try to catch the absolute lows. You want to have a dedicated, systematic, repeatable process that's tested in the trenches that allows you to evolve over time. And we can help you do just that. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, GetRetiredStayRetired.com, GetRetiredStayRetired.com. When you're there, sign up, take advantage of a complimentary consultation, and let's help you uncover this search for yield using various forms of bonds, multi-year guaranteed annuities, or some alternative investments like private credit to generate the income that you need that's consistent with the second pillar of retirement income, generating sufficient interest, payments, dividends, all of that is cash flow to handle your monthly need. I think it's time to get this done before the Fed cuts rates later this year. Now, speaking of the Fed cutting rates later this year, I think there's some real things that people need to be thinking about. I'm going to call them a couple of do's and a couple of don'ts while President Trump looks to navigate the delicacy of trade with so many different countries all at the same time. But if someone can get it done, this administration is going to be able to get it done. In the meantime, you've got questions. We've got answers. Connect with us online. Get retired, stayretired.com. That's 833-964-PLAN, 833-964-PLAN. When you're on our website, download our Trade War 2.0 publication so you can connect with our thought leadership on where we might be going from here and take advantage of that complimentary consultation so you too can learn how to create more permanence and more definition in your portfolio. And there's time decay. The reason there's time decay is it's clear that the interest rate cuts are most likely coming at the end of the year. You can't expect the Federal Reserve to save the stock market, but in this case, you can count on the Federal Reserve if you take action now to lock in rates to generate the income that your portfolio wants. Okay, we're going to talk about some do's and some don'ts while we're involved in this trade war. We're doing that right after this commercial break. You're listening to Craig Bolanos in the Know with VestGen Wealth Partners, AM 560, The Answer.
In the Know Radio with Craig Bolanos on AM 560, The Answer, where his goal is to pummel you with financial know-how until you say uncle.
All right, so what are some of the do's and some of the don'ts while we're in this trade war for all intents and purposes? And I would argue it really began on the 2nd of April. Now, some of it was foretold because, even before President Trump was elected, he stated that he wanted to realign the economy and put America first. That was the big theme of his campaign, put America first. But I do acknowledge that this time has been a little bit different relative to the pace and the disruption that's here. Now, in our first segment today, before we had to pay the bills, that's called a commercial break, we talked about the Federal Reserve, its significance, its impact on you, your money, your retirement, and reminding everybody to lock in yields now and diversify your diversifiers the proper way with permanence and definition. But here are some don'ts during this trade war. Number one, don't count on a Fed intervention to save you. Now, a lot of people have decided that the Federal Reserve is a backstop for the stock market. The Federal Reserve is not a backstop for the stock market. The Federal Reserve can inject stimulus. The Federal Reserve can help spur economic growth, but it's not a backstop for the stock market. And what I want people to make sure they appreciate is the Fed's likely going to be constrained on how much they can drop interest rates, even when growth starts to slow down. Now, I said openly, I do think the Fed's going to cut rates at least 3 times this year, but that in and of itself is not enough to absolutely backstop the stock market. And for that very reason, that's why I think people who are over allocated to stocks based on their risk budget, they need to have a plan to maybe fade or lighten up in the rally just in case. All right. So number one, don't count on the Federal Reserve to save you. We're not going back to ZRIP, everybody. We're not going back to a zero rate interest policy. I wouldn't want to see it anyway. All right. Number two, this is big. This is my second thing of, a list of do's and don'ts during this trade war. Don't blindly assume that yesterday's winners are going to be the future winners. Let me say that again. Don't blindly assume that yesterday's stock darlings are going to be the future stock darlings. And I'm specifically talking about the technology sector. I mean, I get it. We talk about it all the time. We talk about investing in megatrends on this radio show. Megatrends are long-term, undeniable secular trends that are developed through innovation that lead to disruption, which are an investable theme. But don't just blindly assume that what's been working in the recent past is going to be what's going to completely work going forward. And again, I'm talking about the tech sector. I mean, some of those valuations were stretched. Some of those valuations were rich, even though a lot of those companies are really cash cows. But the trade war, it's completely changed this reality. And I think you got to make sure your portfolio is durable, that your portfolio is sustainable, that everything you have, inclusive of your technology holdings, has a quality bias to it, meaning technology companies that are actually generating tremendous free cash flow. Because remember, companies who are generating tremendous free cash flow can do what? They can buy back their shares. That's accretive. Companies with tremendous free cash flow can pay dividends, if not increase their dividends. Companies that have tremendous free cash flow can take advantage of market dislocation to scoop up competitors to increase the verticals of their ecosystem to make their services and their products even more competitive. Okay, so that's a couple of the don'ts. Don't assume that the recent winners are going to be the new winners. Don't just count on the Federal Reserve as a backstop for your portfolio. I think you need to be a little bit more active. Well, what are some of the do's? First, there's nothing wrong with owning mutual funds. Mutual funds are fine, but stock mutual funds definitely have their place in retirement accounts. Stock mutual funds are not ideal for non-retirement accounts. I think for non-retirement accounts, people need to use things that are more tax efficient. That's going to be exchange traded funds, separately managed account, direct indexing. But here's my message to people. You can own individual stocks too. And I know that seems controversial to people, like the only free lunch when it comes to investing is to be diversified. And ETFs give you instant diversification. But I also think, just like in the bond market where we thrive for permanence and definition, I think when we're investing the equity side of our portfolio, there is value in really knowing precisely what you own. It might sound a bit old-fashioned, but owning high-quality companies, especially high-quality companies that paid a dividend and provide the service or product that you know, like, and understand, it can be a sound investment strategy even when markets are volatile. And if you're careful, you can go out and curate a portfolio of individual stocks to complement your broad-based ETFs and other items as a way to get where you want to go. And I think you just need to do it with advisors that have a dedicated process. Do it with advisors that can also align with institutional capability to make sure you're accessing the capital markets in the right way. So my list, do use mutual funds, but keep them in retirement accounts. Do use exchange traded funds for instant diversification, tax efficient, low cost, but also do supplement in the right areas the ability to buy individual companies, individual stocks when appropriate to complement your broad-based portfolios, to narrow the focus, to increase the impact to the bottom line. Now, what else should you be doing on my list of do's and don'ts? Well, absolutely do. If you've been listening to anything we've been saying for the last 7 to 8 weeks now, do consider adding alternative asset classes to your portfolio. Yes, I think this is a market environment near to intermediate term where alternative investments are going to be a value add to portfolios, both in terms of absolute return and, more importantly, in risk-adjusted return. And what could some of those alternatives be? Well, We've talked a lot about diversifying your diversifiers. That means moving from fixed income into the world of private credit. We've talked about diversifying your diversifiers under that theme of pragmatic optimism by taking a focused look at real estate. But again, doing that in the private space, not just with publicly traded securities, aka REITs, industrial warehousing, infrastructure, undeniable secular trends that are leading. Also, do consider alternative assets to your portfolio, like virtual currency. Virtual currency isn't for everybody, but it's for the right people. And I've talked about how things have changed for certain virtual currencies like Bitcoin. Yes, there's tremendous risk, but it's also a story that's 16 years in the making. It's a story that has the support of sovereign wealth funds. It's the story that has the support of some foreign countries with their treasuries. It's a story that's garnering support in multiple red states and blue states where individual state treasuries are talking about being able to diversify into virtual currency. The concept of virtual currency, cryptocurrency, Bitcoin, the story is stronger under this current administration as they've relaxed some of the rules, courtesy of the new SEC chairman. The currency, virtual currency in this case, also better supported as a result of the change to accounting and how corporations do mark-to-market accounting. You also can't deny the fact that the 11 exchange-traded funds that launched 14 months ago, 4 of those 11 Bitcoin ETFs were the most successful ETF IPOs in the history of time. So don't look past diversifying 1% of your portfolio, if you can stomach it, into virtual currency. What are my other do's as we talk about the story of Trump and tariffs and trade wars? Well, you're going to have to wait for this commercial break before I give them to you. But in the meantime, connect with me. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Reach out. Give us a call. 833-964-PLAN. That's 833-964-PLAN. Take advantage of a complimentary consultation. When you go out to our website, download for free our Trade War 2.0 publication so you can connect with our thought leadership on how this is going to unfold and what the strategies are that successful investors are using to get retired and stay retired. Okay, we're going to come back. We're going to talk more do's and don'ts when we're dealing with trade wars and tariffs. In addition to that, we're going to spend some of our time discussing several items you need to do now that some people are advancing Roth conversions into the early part of the year, given security prices are down. You're listening to In the Know with Craig Bolanos on AM 560, The Answer.
More In the Know radio? You can't handle more In the Know radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
We've been talking about some of the do's and don'ts while we're involved in this trade war. And the trade war is going to continue to play out because this is not an event. This is a process of putting America first. It is a process of reestablishing things. That just means it's going to take time. No one likes that things are going to take time, but it's clear to anybody who's in broad-based markets and looking at the macro environment, this is going to take time. What did I say don't do? Don't count on the Federal Reserve as a backstop for your equities. Make sure you have a disciplined and rigorous plan to manage the risk budget, meaning stay invested, but be disciplined. Don't be over your skis with your equities because the Fed is going to be cutting rates, but we're not going back to the zero rate interest policy that we saw during previous issues. Part number 2, do not assume that the recent winners are going to be the future winners. The puck is moving. It's not just Stanley Cup playoff time. It's time for you to think about how AI not alternative investments, but in this case, artificial intelligence is boosting the earnings of non-AI companies. So broaden your portfolios. Do consider dirt cheap, low cost, tax efficient ETFs. Do consider separately managed accounts, but don't shun individual stocks from your portfolio. That's my first do. You can buy individual stocks to complement the rest of the securities that you own, to narrow the focus, to increase the impact. Boy, it makes sense. Do consider adding alternative investments. I'm pounding the table on this, that alternative investments make a tremendous amount of sense because we came into the year with pragmatic optimism. The plan is to diversify the diversifiers. The issue is about the timing, but the adoption of alternative investments, I think, makes sense, not just for the current market environment, but for the intermediate market environment when you take a look at where we're at. Now, what's my next list of do's, things you should be doing while we stay ensnarled in the process that is this trade war, this discussion that is America first? You do need to maintain your cash flow reserve accounts. You do need to make sure you have enough bonds in your portfolio to see you through. You have to acknowledge what's probable, but also pay attention to what's possible. Because if you handle the downside, the upside will generally take care of itself over time. And the easiest way to do that is to make sure you have enough safe money expressed as bonds, fixed annuities, cash, high yield money markets, treasury bills in your portfolio. And whether you should care 1 to 3 years or 3 to 5 years depends on your specific retirement plan. But when you have the simplicity of cash flow reserve accounts, when you have the elegance of simply having enough fixed income, assuming the fixed income, the bonds are owned the right way to create permanence and definition, then I'm not saying that everything else that moves in the market is just noise. But if you put yourself in a position to never have to sell stocks when prices go low, you're already going to have a massive leg up on the competition. And your competition is it's you against you, because you put yourself in a spot to get retired. You just need to make sure that you stay retired. And that means not products, that means processes, and aligning yourself with wealth management firms that are going to give you processes that are TNT, tested in the trenches. And that's exactly what we do here. What's another do as we talk about Trump, tariffs, and letting things play out? This is a time, 2025 is an ideal time, because it always is, but I think it's ripe now. I'm not cheapening it by saying it. I think it's ripe. It's a time to look within and then look forward and re-ask ourselves, what's important about money to each of us at this stage in our life? Our values likely don't change, but our outlook towards what money means to us changes and evolves over time. And let's make sure that we're managing our wealth, aligning our wealth with life. That's called life by design. Let's make sure we're really using 2025 as a chance to reestablish. Listen, everybody, you always get a second chance to do the right thing. So if you think you've been taking on too much risk in your portfolio, well, let's find that out together and then use a disciplined strategy to evolve from where you're at to a place that's more sustainable and more durable. If you think that you've missed out and you should have higher returns, let's use the market dislocations with a process to get rebalanced into the areas that are likely going to grow and be positively impacted. I think all of that means it's time to do a review with your wealth advisor. I didn't say your financial advisor, I said your wealth advisor, because people need comprehensive wealth solutions. There's a gabillion investments that are out there, but you have to curate those investments into a retirement plan that's consistent with the 3 pillars of retirement income: capital matters, generating sufficient portfolio income to cover the spend, and growing the capital base over time to grow the income over time. And those plans come in two varieties. They're goals-based plans or cash flow-based plans. At the end of the day, we need to work to create a set of financial plans based on variance. I mean, inflation's never going to be a constant 2 or 3%. Rates of return are never going to be a constant X or Y. Taxes are not going to be the same today as they are tomorrow. Planning and finding ways to address elephants in the room, like long-term care and continuity of care to protect the healthy spouse. Yeah, these are all big deals. And the way you get through those is you get through the planning process, and we can help you accomplish just that. 833-964-PLAN. That's 833-964-PLAN. Go to our website, getretiredstayretired.com. That's getretiredstayretired.com. All right. Many people have asked, should we be doing Roth conversions right now? Well, a Roth conversion is something we should always be considering. It's not a one-time thing. It's an all-the-time thing. But typically, we do our Roth conversions once we get close to the fourth quarter, because when we get to the fourth quarter, we're able to see all of the income, the earned income, the passive income, the dividend income. We kind of know what the tax return is going to look like. So it allows us to be a little bit more specific and a little bit more measured in what we're going to do. But given that some people have Roth IRAs that are assertively invested, more aggressively positioned, and they might have seen a larger drop in those balances, especially if those IRA balances were concentrated in areas that have been very hard hit, like technology. This might be an opportune time to fast forward and do a small, easy, no-brainer Roth conversion in the spring of this year, and then seeking to top off that conversion in the fall. I want to talk more about those considerations and conversion planning opportunities, but we got to pay the bills. That means we're going to have to do a commercial break. But in the meantime, download for free at getretiredstayretired.com. Download for free at getretiredstayretired.com, our Trade War 2.0 publication. Surf around on our landing page. Take a look at all of our media and TV so you can connect with our thought leadership and our voice. Then take advantage of a complimentary consultation today. Whether you recognize that you need an annuity upgrade, whether you recognize that you own all these bonds, but you don't have individual bonds, or you don't have bond funds that have defined maturities and defined targets in them, and you long for that search for income, and you recognize that building in alternative investments is probably the evolution that your portfolio needs for the next part of this journey, we can talk about all of those things to empower you with information. Take advantage of that complimentary consultation today. GetRetiredStayRetired.com. Okay, more to come. Craig Bolanos, In the Know, VestGen Wealth Partners, AM 560, The Answer.
Like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560, The Answer.
It's Roth IRA time, and are you thinking about converting some of your traditional IRA to a Roth? Well, yeah, now might be a really good time to consider it. But before you push the button, before you pull the lever, before you hit the E sign, there's a lot of factors you got to consider, a lot of things you got to contemplate. Let's break those down and get serious about it. Again, listen, guys. Age wave demographics and population density studies have shaped economies, shaped policy the world over, time and time again. It's rinse and repeat. And I've said before that when you have more people retiring in 11 years than have ever retired in the history of America, that means America's getting old. Call it aging demographics, call it the graying of America. I don't care what you call it, but it means this. We already spend way more money on things like Medicare, Medicaid, Social Security. Oh, yeah, throw in some things like we need national defense. There's only one way, guys. Revenue is going to have to get raised. Are we going to raise enough revenue through tariffs alone? I don't know. I think there's going to be other administrations that are going to want to raise revenue by raising income taxes. And they're always going to say the tax raises are only going to go on the wealthiest Americans. But then they never define who the wealthiest Americans really are. And then you're sitting in your middle class suburban Cook County or downtown Cook County property, and you get ripped with property taxes, sales taxes, amusement taxes, plastic bags taxes. Well, I think the beverage tax never. My point is, guys, taxes are going to go up. You even got to worry about this. You live in Illinois or you live in some state that doesn't tax your retirement account distributions. What happens when your state runs out of money and they start coming for a piece of the action too? These things are all really real. So I think you got to be looking at Roth conversions. Why? A traditional IRA, you put the money in, it grows tax deferred, everything you take out is taxable. Okay, maybe that's good if you're working and you're constantly in a 32 to 35 or 37% bracket and you retire to a 12% bracket, but that's not reality for most people. A lot of people end up retiring to a similar tax bracket in retirement compared to when they were working. And the fact that you can distribute money from a Roth IRA tax-free forever, oh, I don't know. I think that's absolutely fantastic. The fact that a Roth IRA benefits VestGen, fantastic. But let's just focus on you. Let's just focus on us. I want to future-proof my retirement, and that means getting as much money as I can into the tax-free safety zone of the Roth IRA. Now, the fact that Roth IRAs don't have required minimum distributions, hey, that's a big bonus. The fact that my adult kids would love to inherit my Roth IRAs because the inheritance of those is much more friendly compared to traditional IRAs. But listen, when we're doing conversions, we need to remember that once you do a conversion, you can't undo it anymore. Prior to 2018, you could convert some money from your regular pre-tax IRA to a Roth IRA early in the year, and then you could undo the conversion if it had bad tax consequences for you. That's been gone. That's been gone since 2018. So now if you do a conversion in April, you better make sure that you really did your homework and have thought about what the impact's going to be on that 2025 tax return. Next, you need to pay attention if you do Roth conversions, not just to marginal tax rates. You need to look at all of the deductions or credits that you might be phased out of or cliff tested away from. Especially credits, because tax credits are dollar for dollar. They're free money. And if you're in that middle class 22 to 24% tax bracket, you bet there's a lot of phase outs and cliff testing in those areas. Next, what if you're retired? Everybody knows by now, because I've been screaming about it for 13, 14 years on this very radio station, that some people get Medicare for significantly less than other people pay for the same Medicare. Thank you, IRMA, right? That's the means testing of Medicare. We've been means testing Medicare since 2005. And depending on how much conversion you might do in 2025, it could affect adversely your 2027 Medicare premiums. So I think it's this. You've probably already been doing Roth conversions. If you haven't, maybe you should. A lot of people know that they might not be doing Roth conversions today because they're waiting to get into the valley of their retirement income when their tax rates might be a little bit lower. But the bottom line is get some professional help with people who aren't going to just ballpark it. You need precision. And that's exactly what we do at VestGen Wealth Partners is we give you precision. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. GetRetiredStayRetired.com. Now, why do I talk about the word precision? Well, we've always talked that if you want to get retired and stay retired, if you don't just want to survive, but you want to thrive in retirement, it's going to take preparedness and flexibility. That's basic table stakes, preparedness and flexibility. But it also takes precision because retirement is a execution business. It's an execution business. There's so much IQ that's out there. Reading the internet, talking to people, listening to opinions. But ultimately, you've got to have another form of IQ. You've got to have really good implementation quotient. That's the ability to take this intelligent quotient and turn it into discernible action to improve the lives of yourself and your loved ones financially. And if you're looking for some guidance, you're looking for reassurance, you're looking for a relationship that's more comprehensive, more holistic, something that's truly integrated, something that's done under a fiduciary standard of care, then connect with us. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. When you're on our website, download our Trade War 2.0 publication. Connect with our thought leadership. Play some of the videos and media appearances I've done recently, whether it's CBS, ABC, WGN, you name it. Get a taste for how we interact, what we think, what's happening, and start making some plans. You're always going to get a second chance to do the right thing. And as markets begin to work themselves out, you should have targets in your portfolio, meaning above current stock indices and below current stock indices to take discernible action. We have those, and we'd love to share them with you. In addition, we talk time and time again that our theme for 2025 was one of pragmatic optimism. That pragmatic optimism is still here. But part of our implementation theme that was supposed to be in the second half of the year that we've pulled forward into the spring is diversifying the diversifiers. And that's why I've been pounding the table on alternative investments in the right form for the right clients to provide the right solutions, because it's hard to think that the next 10 years of investing are going to look like the last 10 years. This is a changing landscape, and I think people need to broaden their portfolio beyond traditional stock and bond investments to get the consistency, durability, permanence, and definition that everyone longs for. You're listening to Craig Bolanos, VestGen Wealth Partners, AM 560, The Answer.
Ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
Financial planning in the shadows of dementia. It's tough, guys. It is tough. If you have a loved one who gets diagnosed with dementia, gets diagnosed with one of the stages of Alzheimer's, I got to tell you, you got to move fast on legal safeguards, move quickly on estate planning, and more so, you got to give your loved one agency, recognize capacity, and get comfortable having uncomfortable conversations. It's a terrible disease. Alzheimer's, the shadows of dementia. It's terrible. The costs are horrific. People know what the home health care costs are. If you don't, it's crazy. People are paying $28 to $35 an hour. People see the graduated care that goes through assisted living. People know what has to happen once people graduate into SNF, skilled nursing care. It's financially devastating. And there needs to be a plan to use personal assets. There should be a plan for the right families to partially insure, because again, there are now solutions out there that answer the questions like, what if I die without ever using my long-term care insurance? Great. You can structure a policy now so that the premiums you paid are going to come back into your estate, so it's not squandered money. That's a big deal. Number two, the ability to have indemnity, cash indemnity policies, not just reimbursement policies. So you could have a loved one provide that care. That's a big deal. I think third, the simple fact that if somebody wants benefits that don't just go 2 years or 3 years or 5 years, someone still wants to craft a story of 6, 7 year or lifetime benefits, they're available. And the fact that some carriers are still doing underwriting without taking into consideration family history, that's not going to be here forever, but that's here now. And I encourage you that whether it's the estate planning side, the cash flow side, the insurance side, any side of planning in the shadows of dementia, Alzheimer's, I got personal experience with this. A lot of you do too. And we stand ready to help. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com, getretiredstayretired.com. Take advantage of a complimentary consultation and let us walk with you under the principle of stewardship to protect your loved ones and your estate.